In the previous video, we went through the perilous path to the Open Mainnet. We identified the single biggest risk of the launch, the Great Sell-Off, a wave of massive selling pressure from millions of pioneers wanting to withdraw for the first time. For months, the entire discussion around Pi's economics has been obsessed with one thing: its massive 100 billion coin supply. But supply is only one side of the equation. It is meaningless without the other half: demand. Price is set at the point where supply and demand meet. We know the supply is huge, so to understand Pi's future, we must investigate the most overlooked question in the entire ecosystem. Where will the demand come from? Who will buy all those Pi? In the next 40 minutes, we will do something no other channel has done. We will build a complete bottom-up analysis of every potential demand source for Pi. This is the other half of the economic story. Welcome to Pi Decoded. Part 1. The 3 pillars of crypto demand, an analytical framework. Before analyzing Pi specifically, we need an economic framework. Demand for any successful cryptocurrency is built on 3 distinct pillars. Pillar number 1, speculative demand. This is the most common and powerful driver in the short term. It comes from traders, investors, and retail participants buying a coin not to use it, but because they believe its price will rise. They are betting on future price appreciation. This demand drives trading volume on exchanges and creates large price volatility. Pillar number 2, utility demand. This is demand from people who need the coin to do something. With Ethereum, you need ETH to pay gas fees for transactions or to interact with DeFi applications. This demand is tied to the actual use of the network. It usually builds slower, but is much more sustainable than speculation. Pillar number 3, store of value demand. This is demand from people who view the asset as digital gold. They buy it to hold long-term, protecting their wealth from inflation or economic instability. This demand is driven by trust, security, scarcity, and a long operational history. To understand Pi's potential, we must analyze its strength in all 3 categories. Part 2. Analyzing Pi's speculative demand. When Open Mainnet launches, the initial wave of demand will be almost entirely speculative. But where will it come from? Source number 1, retail mania. Pi's greatest strength is brand recognition. With tens of millions of users, it is one of the most famous crypto projects on the planet. When it gets listed on an exchange, it will be a major media event. This will surely attract a huge wave of retail investors who have heard about Pi for years and want to join the game. Demand driven by this hype can be very large, but also extremely volatile. Source number 2, institutional investors, VCs, funds. Will the big money, venture capital funds, and crypto institutions buy Pi? Let's be realistic. Advantage. They are attracted by Pi's massive, KYC-verified user base. It represents a large untapped market. Disadvantage. Pi's corporate structure is not VC-friendly. Governance mechanisms are unclear, and the huge, non-scarce supply is a major red flag for investors looking for the next 100x digital gold. Verdict. Initial demand from institutions will likely be very low or non-existent. They will wait and see. Source number 3, market makers and exchanges. When a coin is listed, exchanges and professional market makers provide initial liquidity. This is a form of technical demand, but it is not real investment. Conclusion on speculative demand. Pi's speculative demand rests almost entirely on retail investors' shoulders. This can create a large initial price surge, but it is notoriously unstable and can disappear as quickly as it arrives. Part 3. Analyzing Pi's utility demand. This is the core team's long-term bet. Can they build enough utility to create sustainable demand? Source number 1, internal economy, consumers. This is demand from pioneers who want to spend their Pi on real goods and services within the ecosystem. As we saw in the ecosystem video, applications like Pi Chain Mall facilitate this. Every time someone buys a product with Pi, they create utility demand. Analysis. This demand exists but is currently very small. To make a real impact, the ecosystem needs millions of high-quality products and services that people genuinely want to buy. Source number 2. Developer economy, builders. This is demand from developers who might need Pi to deploy or promote their apps on the platform. On other blockchains, developers are a major source of demand for the native coin. 8. Analysis. This type of demand is almost non-existent for Pi at this time. The core team is currently subsidizing development through hackathon contests, but a real developer economy has yet to emerge. Conclusion on utility demand. Although this is the most important pillar for long-term success, Pi's utility demand is currently immature and fragile. It is not strong enough to absorb a large supply shock from the Open Mainnet launch. This is the core reason for the delay. Part 4. Analyzing Pi's store of value demand. Finally, let's address the Pi is the next Bitcoin story. Can Pi attract demand as a long-term store of value or digital gold? Let's evaluate it based on the key attributes of a store of value. On scarcity, Bitcoin has a hard cap of 21 million. Pi has a hard cap of 100 billion. On this metric, Pi is designed for abundance, not scarcity. Decentralization. Bitcoin's decentralization has been proven over 15 years. As we discussed, Pi's network is currently centralized around the core team. History and trustworthiness. Bitcoin has a long history of safe and stable operation. Pi's mainnet remains largely untested in an open environment. Conclusion on store of value demand. Pi is not designed to be a store of value like Bitcoin. Its characteristics are those of a medium of exchange, not digital gold. Therefore, long-term HODL demand from investors seeking a safe haven will likely be very low initially. Conclusion and strategic dilemma. So, after this 40-minute economic investigation, who will buy 100 billion Pi? Our analysis paints a clear picture. At launch, demand for Pi will be overwhelmingly dominated by retail speculation. This demand is strong but dangerous. It creates bubbles and crashes. Utility demand, the only path to sustainable long-term value, is still in its infancy. It is a fragile seedling, not strong enough to withstand the storm of an open market. Store of value demand is currently negligible. This explains everything. It explains the core team's strategic dilemma and the reason for the prolonged delay. They are in a desperate race. They must build a real, utility-rich economy strong enough to create sustainable demand before the speculative wave driven by initial hype inevitably fades. If utility is not there when the hype dies down, no one will remain to buy. We have analyzed the project from almost every angle. But how does it stand compared to direct competitors? In the next video, we will start a brand new mini-series, Pi versus the world. We will begin with the ultimate showdown, a direct comparison with the king of crypto, the project it is most often compared to, Pi versus Bitcoin. Subscribe so you don't miss the first part of this epic comparison.